Well, for banks, the European debt crisis and the U.S. housing crisis have a lot in common. The reason, well, they both involve assets that still need to be written down. At least that is according to our next guest, Charlie Smith. He is CIO, Chief Investment Officer at Pitt Capital. He says housing is still the #1 issue as far as sentiment goes for U.S. markets. Europe, #2. Charlie is joining us right now from Pittsburgh this morning. Charlie, how cheered were you then by the continuing housing numbers? They came in a little bit better than expected.
Well, a year-over-year change in Case-Shiller down four and change. Not a whole lot of change in that number. The last 4 or 5 months, we have seen sequential increases in home prices. I think that has to do more with the fact that the robo-signing scandal had created a shortage of new foreclosures, and then we saw in August a big pickup in the new foreclosures. So I wouldn't expect home prices to be any stronger for very much longer. I would expect the downtrend in home prices to resume here right about now.
Even more to fall. In other words, you don't see a stabilization.
No, I would expect to see the average home price in the U.S. decline 3 to 5% annualized for the next couple of years.
So what does this mean then, Charlie, for investors? I mean, I know you see this as a really important part of market sentiment.
Well, I think what it does is it creates trepidation on the part of the banks and an unwillingness to go out and really grow their loan book because they know they've got these legacy assets from the last cycle on their books that are just not up to par, and they need to therefore keep excess reserves. You know, the Fed has created nearly $2 trillion in excess reserves over the past 3 years, and the banks have refused to lend because they know that they've got these what I call Swiss cheese assets from the last cycle on their books. And until we reconcile these and write these assets down to their proper value, it's going to be tough for the banks to begin to lend.
So, Charlie, I take it you're probably not advising your clients or the people that you work with to invest in banks. So what do you like in this kind of environment?
Well, the segments where we've overweighted include telecom and aerospace. Telecom primarily because even though you may see a cut to your income, you're unlikely to give up your cell phone or your remote control. And the infrastructure spending on the part of the big telecom companies is declining as a percentage of their revenue, so their cash flows are improving. So telecom's an area where we focused, and also aerospace, because worldwide air traffic, even throughout the downturn, continued to grow, and the backlogs on the part of the major aerospace manufacturers, such as Boeing and Honeywell, are at all-time highs. So even if we do see a weak spot in the economy, the numbers for the avionics and the airframe suppliers should be pretty good.
Charlie, you just named some very solid companies, all of which have significant cash on the balance sheet. How frustrating is it to you as a CIO that even these quote-unquote quality names are trading along with basically in a basket of U.S. stocks that are just being traded as one single security?
Well, that's one of the things that's really surprised me over the past year is the way that the correlations have risen significantly for the average stock. And there's the attitude has been engendered that stock picking has no value anymore. I think the results that we've been able to put up for our fund over the last 3 years would tend to refute that. If you can go out and find well-run businesses at reasonable prices and differentiate the ones that are able to grow a little bit from the ones that are having problems, you can certainly add value from picking individual businesses, and that's what we try to do.
And that's what you try to do, Charlie. And then what is your time frame? I mean, how patient does an investor have to be?
Well, our turnover is in the 8 to 10% range, so we're looking at a 10 to 12 year time period that we hold our investments. The ideal holding period is forever. No business is completely bulletproof, and you're not going to be able to hold a business forever. But we want to make sure that we own businesses that are going to be able to compound shareholder equity at some rate above the S&P for an extended period of time. And typically, when we go into an investment, it'll take us 2 to 3 years to fully understand a business. So we have a perspective which says that equity doesn't get built over a short 6-month time period. It takes 2 to 3 years to really understand an investment, and at least 5, 6, 8, 10 years to see the equity really compound.
So quality still counts, Charlie. Thank you. Charlie Smith joining us there. He is the CIO at Pitt, and that is in Pittsburgh, Pennsylvania.